Good afternoon, girls. This is a repeat of the lesson that I did today in lesson 9 at school for those that were not able to be there. So if you were there, you do not have to follow this lesson, but if you want to get some extra reinforcement, you are welcome to. Right, so we're looking at taxation, and we've dealt with tax in previous lessons and in last year's syllabus and in a little bit in Upper 5. But we're looking now at income tax particularly. And income tax, as it says in your textbook on page 214, it does include all taxes that are levied on all income. So it's not just income on your salary and profit received by individuals and businesses. And it's managed in South Africa by SARS, the South African Revenue Service. You are liable for income tax if you are over a certain threshold. In other words, if you earn more than a certain amount of money per year, you're legally required to pay tax, and if you earn less than that threshold, you don't have to pay tax. The thresholds kind of change each year, and the example that they're speaking about in the second paragraph was in 2011, which the threshold amount was 57,000 rand per annum for people under 65 and 88,528 per annum for people over the age of 65. I think this year it's roughly somewhere in the 200,000s per annum that you don't have to pay tax, but I could be mistaken. All right, so income tax is calculated using a sliding scale. In other words, what that means is if you earn the minimum amount that you have to pay tax, you'll get a certain percent that you have to pay tax. It could be 6%, for example. The moment you start earning more, then your tax percentage also increases. So it could become 10% or 20%. And the highest earners in the country pay the biggest percentage of tax, maybe in the 40s, 40%, etc. So yes, the more you earn, not only the more you pay as a portion of your income tax, but the portion becomes bigger itself the more you earn as well. All right, so if you have a look at the steps that SARS follow in order to calculate your income, they firstly determine your gross income. Gross income is your total income that you receive on your salary slip before any deductions are made, whether it's tax, whether it's medical aid, pension fund, any of those. That your gross income includes all of that. Then on your salary slip, it'll show you all what your deductions are, your tax, your medical aid, etc. And the final amount at the bottom of your salary slip that's paid into your account is the net amount, NETT. All right, so they first determine that gross income. And a resident, which is a South African person, gross income is the total amount of worldwide income received. Even if you receive income from another country for work that you might do there, you have to legally pay tax on that income in South Africa. The second thing they do is they deduct income from which you are exempt from tax. And there are various exempt incomes, such as your pension, your pension amounts that you pay every month, and if you pay extra medical expenses that are not covered by your medical aid, you also don't get taxed on those expenses, so they deduct that from your taxable income, and retirement annuities and things like that. For number 3, they deduct the allowable deductions. So in other words, everything that can be deducted, they then take that away. And what is left over is your taxable income. In other words, the final amount, which will be less than your gross salary, that they can tax. And then they use number 4, the percentage in the tax table on that taxable income is what you'll have to pay. And number 5, subtract rebates and credits. A rebate is an amount that is subtracted from the figure calculated using the tax tables in order to determine the tax payable for the year. The value of the rebate varies from year to year. So in essence, there are 3 types of income. There's firstly your gross income. That's the total amount of money that you get in. That includes all the money that you can be taxed on, all the money that you can get deductible taxes on, and all the money that is not taxed. The second type is your taxable income. That's once they've subtracted all the amounts that you're not going to get taxed on, the money that's left over is what they can tax you on, and then they will apply that sliding scale wherever you sit on the threshold. In terms of what you earn, they will then take a percentage of that. And the third type is your net income, and that's once they've taken away all deductions. That's the actual money, the money that goes into your account and is available then to you. We did discuss in class as well that even once that money is in your account, that net income, you are still subject to taxation, because whenever you buy something, you pay VAT, and which is a different type of tax, not income tax, but it's value-added tax. And so we discussed how money comes into your account, it's taxed, you then get what's left over, but then when you spend that money, you're taxed again. And when you withdraw your pension after you're retired, you are taxed again. So basically, anytime there's a transferal of funds, you are taxed on those funds, unless you can apply for them not to be taxed. And there's certain exempt things, as we discussed with VAT, things like bread, vegetables, the basic staple things are not taxed. And girls, if you can now complete exercise 1, page 214, and it does refer to the guide to completing your individual income tax return on page 377 of your textbook. I have included that on the WhatsApp group, so you can access it there and then go through exercise 1, and we'll deal with the rest of that in class tomorrow. I will send out a Teams invite again, and we will continue the Teams live lessons for as long as I see fit, but we are going to move more to a focus on the girls who are present in class, and that's an encouragement for you that if you can make it to school, please come and join us.